What's up, real estate world? This is David Clemens and Caleb Delgado here with How to Make Money with Hard Money. And today we're talking about the great divide in the real estate market today.
Today's real estate market. What an enjoyable thing.
Yes, it is one of a hot topic, something that, is prevalent in the media right now. And so we figured we'd jump on here today to discuss what we're seeing on the ground as, real estate investors in a hard money lending company. So
yeah, I think a lot of it starts, the main focal point is expectations.
Yeah.
I think people are making a lot of assumptions about expectation. They're buyers and sellers, property values. So I think that's where we have to start. And that's the focal point because what's happening in today's market is not what's happened for the last 5 years or even before that. So in unprecedented markets, it's time to reset, reanalyze, and focus on the true expectation for today.
Yeah. Reevaluate. And, there's this mentality that kind of tries to carry over from previous experience. And when these outside influences change, like interest rates, insurance, expectations, that you have to shift with it. To your point, you got to be adaptable.
Well, we got to be water, right? We got to be water.
Yeah. So on buyer and seller expectations, I think we talk a lot about this on our team, and there's two topics here or two sectors. You have residential real estate, and then you have commercial real estate.
Right.
Under commercial, you can allocate office, multifamily, these types of asset classes. So what are you seeing? Let's start with commercial. What are we seeing in commercial side?
Well, on the commercial side, I mean, there is a lot of delay, not so much activity. I would say is the first thing. Is I believe the values in general and the cap rates, the expectation is too high.
Yeah.
And then the cost has risen between insurances and just management costs and interest rates have all risen. So people have these high expectations for this value price that is just not sustainable because of the cost.
Yeah.
And that's what, we've seen on the commercial side. And on, the only way to combat it too is to offer lower prices. And these sellers are not used to selling at these lower prices because they're still on low interest rates. So the demand to sell or their ability or desire to sell is not that great.
Yeah. And then sometimes it's because they might be having to sell for a loss. And who wants to do that?
Right.
If you overbought 2 years ago and now the market is stabilizing or dropping in values, then who wants to push a sale for a loss if you're sitting on a low interest rate? Now, I think you're right. It's stale. There's a complete stalemate in the market right now. That's what we're seeing on the commercial side.
Right.
We've seen groups that were doing almost 800 million last year that are, under 10 million in volume. One of the big commercial brokers we were speaking with the other day did 44 deals a month, and he's down, or 44 deals, and now he's down to 2. So I think that's a common trend right now on the commercial real estate side. Right. And when you speak to anybody that's primarily on commercial, they're telling you that it's because of these cost increases and that buyer-seller stalemate right now.
Right.
And the two big ones, I think, are insurance in the state of Florida and interest rate.
Yeah, the insurance crisis. But the good thing is, and the greatest part about real estate and us, is we still finding success.
Yeah.
We bought 2 houses this past week.
Yeah.
We're still finding opportunity. But I think go into the fact of how we're finding that opportunity and what you think, how we're finding success, really.
Yeah, well, it's about being adaptable, right? Because we are, by nature, we've done a lot of multifamily projects. We love multifamily.
Right.
We own multifamily. And we prefer to keep pursuing multifamily.
But we haven't bought this year.
But we haven't bought in the last year and a half even.
Yeah.
So that's been challenging and something that we've been pursuing and attempting to buy, but we've had to shift over to residential real estate assets because that's what's available. That's what, we feel strong, more confident around that type of product, and we're able to make the DSCR or the debt service coverage ratios work on higher interest and the higher insurance. But we let the numbers make our decisions for us. Right now, we're pretty clear on what we want and what type of returns we're looking for as a group.
Yeah.
And if we can find an asset class that meets those return expectations, then we're going to take the deal. Because we have capital to place.
Right. And I think going over how we evaluate deals different now than we've done the last, 18 months to 2 years, that's I think the big change is.
Yeah. I mean, we listened to that commercial broker speak about staying on the commercial side for a little bit, is that, we own a 20-unit apartment complex. We've talked about that before. Our insurance quote came back. It was $16,000 a year previously. It's a fully renovated product. And our premium comes due, and it's $36,000. It's
what I call that is a deal crusher.
it's a double, and luckily we're locked in for 5 years on an interest rate. So we're sitting pretty at a 2.5% rate.
Right.
But, the rates in the market right now are 7.5%. So new buyers in the market that are buying at 7.5% rates and insurance premiums that are 2 times what they were a year ago. And even to add to that, the rents in the Tampa Bay area are stabilizing and even dropping slightly. So, so you have, revenue dropping and your costs and expenses are increasing, which are crunching those NOIs or the net operating income.
Right.
And so, the property's making less money. So the value is worth less.
Right. And I think explaining that to people or going over, because when we evaluate for our loans, and I'm talking to, borrowers and investors, and I'm having that conversation of, the property's worth this much, and I'm counteracting. I'm saying, no, it's not. And they're like, well, why do you feel that way? I'm like, well, look at the true cost.
Yeah.
And I think focusing on cost and today's cost is very important for people, because it's been such a great windfall in real estate over the last decade that people haven't adapted to these higher costs, which have to lower your price when you're making your offers.
Yeah.
So they're coming to us on the loan side and we're saying, what? Oh, I need X amount of loan, but we're giving lower loan amounts because we believe that those values are too inflated.
And even at lowest Ave, if somebody came and offered us a lower purchase price, we wouldn't accept it right now because we're around 2.5% debt and we're not motivated to sell.
Right.
So that's kind of that's that stalemate that we're talking about, that gap in expectation.
Right.
So, the buyers have to buy with this inflated insurance and interest costs, and all of the costs are inflated right now.
Yeah.
The revenues are down and the sellers aren't motivated to sell. So that's where you get this standoff and no transaction flow on the multifamily side specifically.
And the way, we've combated with our borrowers is coaching them how putting more capital down or stabilizing their portfolio to collateralize more in order to meet, the correct cost, because yet again, they pay a certain price and they take on massive amounts of debt. They're not going to be able to make the deals work.
Yeah.
So the only people that are surviving in today's market are the people who have the ability to put more capital invested and or collateralize more real estate, so that way they can get the proper loan.
Yeah, what you're talking about is weathering the storm, right? Survive till 25. Is what we heard going around, a little slogan, is because it really is true, is like, if you can survive until, we're hearing a lot of experts talking about this could last for another 18 to 24 months,
Right.
So if it does, who knows? But if it does last for another 1.5 to 2 years, then if you're operating on a negative cash flow, you're going to be motivated to sell. If you can sustain positive cash flow and you have, manageable debt, then you can survive and get through this tough period.
No, for sure. And going into what we've purchased and how we found success in those 2 houses is because the reason is they positive cash flow or break even and someone's paying off our debt.
Yeah. And you're talking about the 2 deals for those who don't know we just purchased 2 single family rental properties in the Holiday area, 140, 150K purchase prices, 20 to 25K rehabs. They'll be worth 225 to 240 when we're done, but we're going to stick tenants in there for 1,500, 1,600. What we're looking at, though, is an 11% cash on cash return, with 30-year debt. So we're fixed rate debt. And what did we get for debt this week?
7.9%, 30-year fixed.
And that's high, that's really high. Yeah. But we were able to make the pro forma work. We're at 1.25 on the DSCR, or the debt service coverage. 11% cash on cash. You have a 30-year mortgage in place where the tenant can pay the rent or pay the mortgage down. Sorry.
Yeah. And what you said there is 7.9% was high. But think about it relative to the past 30 years.
Thank you for that correction.
Right. So it's like the last 5 years of real estate at 2 and 3% interest rates is absolutely absurd and unprecedented.
Yeah.
If you're looking at the past 30 years, it's 7.75 or 8% or somewhere in that range of where the average has been over the course of, the last 3 decades.
Yeah.
So when people say things to me like, oh, their interest rates are too high, I'm like, no, it's normal. This is the normal real estate market. So the people who understand that and can adapt to that and just really take it in and not look at it for, this is just too high and I don't like it because it's not 2 or 3%. No, that's not the truth. Evaluate the deal. Understand, are you paying too much? Are you not putting enough down? What are you?
The controllables.
The controllables, yeah. The controllables. So I think people have really, have to adapt to that first before they can truly be successful moving forward. And like we say sometimes, the best move is not doing a move at all sometimes. We just need to sit still sometimes if you don't know what to do.
Yeah.
And for us, we've been patient. we haven't jumped at every opportunity because we've had a lot of opportunities. I think there's more buying opportunities than we had in a long time.
Yeah, certainly.
And then I'm also seeing too, a lot of people not being able to get out of certain loans. I mean, how many refinances are we doing versus fix and flips now?
Yeah. I mean, from a lending perspective, we went from over 70% fix and flip products to almost over 70% refinance products. And what Caleb's talking about is a lot of these refinances that we're procuring for borrowers, they're actually just refinancing other hard money loan debt. Yeah. And a lot of other hard money lenders do not offer 1-year loan extensions. So we offer renewals at DKC Lending. If you've been in compliance with your note and mortgage, we'll offer you a 1-year additional extension to your maturity date.
Right.
Now, other lenders don't do that. So when you come up to the maturity, and some do, some don't, but when you come up to your maturity date, you go into default if you can't pay the loan off. Right. So then you're taking at 18% interest. It becomes now you are in distress. There's a pre-foreclosure filing, and now you have to refinance with another lender who knows you're in default. Yeah. Now there's questions around why are you in default, right? So it becomes a difficult situation to navigate. But we've been trying to help as many of these borrowers as possible refinance out of that bad debt per se, and get into a more sustainable product.
And think about that conversation. A lot of these lenders are not even accepting people's payments once the maturity date's there.
Yeah,
and they're just saying, "All right, good luck. You pay me off as soon as possible." And it's forcing people to.
What does that mean, right?
Right. What does that mean?
They want their money back.
Yeah, people want their money back. I mean. So but going
and why? Sorry to interrupt, but why? Right? Because a lot of investors want to be in a cash heavy position right now.
Right.
So they're calling notes due to get cash heavy because there's a lot of uncertainty in the market. Right. So they're
which
trying
means opportunity,
or potentially a period of uncertainty, and they want to be in a leveraged position.
Right. Yeah. I mean, I think chaos always equals opportunity. Always. When people are either skeptical or unsure of the next move, while we're patient, some people are erratic.
Yeah.
They don't know what to do. So they'll just do anything to get out of their deals. They'll take losses. They'll sell things off. But for us, that's why we talk about the deals that we purchased. We're very tight on making sure that cash flow, and even if we have to leave money in the deal, we will bridge that gap.
Sure.
We're having that explanation to borrowers or other investors. I say it all the time. I said, just make sure you have cash available to bridge your gaps and make sure you're comfortable. Don't overextend.
Yeah.
That conversation is the best conversation I'm having now, where I'm like, look, don't overextend.
Yeah.
All these people with these, I'm doing 100 and 100, I'm doing 90 and 100, I'm trying to do all these products. It's like, yeah, but I understand you want the highest debt, but that doesn't mean it's a good deal.
Right.
Right.
It's a great point.
So it's like, why go into all that? It's all about buying right and having the right deal,
providing
first.
Options, really, because when you're talking about too, when you have lower debt and you have more cash, you have more leverage, you have more options available to you too.
Right.
So you're exactly right.
Yeah.
So talking about that, even like how we're underwriting deals a little bit, to your point, it's hard to review a property and compare it to a property that's sold within the last year or two in that area, and using a price per square foot calculation.
Right.
And that's a change in how we're underwriting or evaluating deals, because you really have to look at the cash flow, like you said, the DSCR. We keep saying that's the debt service coverage ratio, and the cap rate.
Right.
So we're looking more at how the property cash flows within today's economic interest rate environment.
Right.
Versus 2 years ago when debt was at 2.5% and now it's at 7.5%.
Right.
The property value changes and how that's impacted.
Right.
We have the example we brought today where it was a $300,000 loan at 2.5% is $1,185 as a monthly payment. $300,000 at 7.5% is $2,100.
Yeah.
So you're talking about a 77% increase on your monthly payment from that rate change that happened in 8 months.
Right. And so then so you're speaking exactly, I mean, you're right. So how could you take data or just, evaluation from 2 years or even 12 months ago when that's not even applicable now?
So, yes, exactly. So what we're doing for those asking is that we're looking more at cash flow.
Yeah. Based
on current debt in today's environment. And I think that's what a lot of other savvy investors are doing. We read that article from the commercial broker.
Right.
And that is certainly more prevalent on the commercial side and multifamily side than maybe residential. Mm-hmm. If you're going to use price per square foot comps in residential circumstances, perhaps using 90-day comps, very relevant comparables.
Right. Tightening up on those evaluations, closer to your, closer on your radius for your comps.
Sure.
Sooner, 3 months, 90 days.
Right.
So yeah, using that type of analytics is the best move in today's market. Or like I said before, sitting still and being patient.
Yeah, I think you said it before we aired. It's like the decisions you don't make can be just important as the ones you do.
Right. Because one false move, it can clear out your whole portfolio, and then you have to sell for a loss. And that's not what we're here to do. We rather sit and wait it out. We want to be the last one sitting at the table.
Yeah.
You don't want to be the first one out.
So I think it's probably important that we touch on insurance for a little bit too.
Yeah.
We've mentioned that, our insurance policy at our multifamily, as a good example, doubled. We were able to lock in something around 28,000 from 16,000, still almost double. But what are you seeing from borrowers? You're on the front end of these borrower conversations. How is the insurance market influencing these transactions?
Big, because the qualification, getting insurance is tough now. Before, when it was just a snap of your finger, hey, call any insurance agent and no problem, done, you have insurance.
Yeah.
Where now, is so many carriers have left the state of Florida specifically and the South because of hurricanes and damages.
And fraud.
And fraud. And roofing fraud specifically was one of the big ones they put in a lot of the media. But with all those elements, insurance has been very difficult to procure. And then the requirements are super high. The 4-point inspections are even tighter. So with all that happening, it's driven costs such an increase that, and people don't even realize, or they're not even prepared for it. I think that's the biggest part.
Yeah.
Is they're not prepared for that increase, and they're not evaluating deals properly because of it. We've had to expand our insurance, not carriers, but brokers.
Yeah.
Because, getting mobile home insurance versus getting single family insurance, disaster. And now we're talking about
occupied versus builder's risk.
Yeah.
There's all different types of policies.
Right. I think one of the big things was maybe getting wind mitigations removed and items like that to help save. I think you could speak a lot on that because you've been very creative about, assessing insurances through trying to save money that way.
Yeah. Actually, one of our investors put me onto a new product recently, and that was through a life insurance company. Mm-hmm. And they were offering financing without wind mitigation insurance needed.
Right.
Which on some of these larger multifamily projects, that cost savings can be substantial. And even it can represent a significant percentage of your cash flow or your NOI.
Oh, yeah. We're doing a loan we closed Friday, a 7,000 square foot mansion in Naples.
Yeah.
Getting the wind mitigation removed from the insurance was $19,000 a year. That one component.
Annual premium.
It was a $30,000 policy, but $19,000 of it was like $19,700 was wind.
Did that include the flood too?
Yeah.
Yeah, because that one was a flood.
That was flood.
That's serious when you're talking about your annual expenses and making sure. So, getting savvy in this, because, I don't think we have a couple of investors who have owned insurance companies also. I think if you speak to some of them, they're not hoping that this insurance issue will, be around for a long time.
Right.
I think we're in a unique time where the state of Florida is trying to figure it out. And, I think they're trying to come up with solutions. They passed recent regulations it probably wasn't enough, but they are trying to figure this insurance conundrum out. Yeah. And so I think it's about getting creative in the interim.
Yeah.
And can you, negotiate with your lender to try to, make exemptions on insurance policies?
Yeah.
Can you try to explore different brokers to get different products? You really have to be savvy in this market, because if you can really save a lot of money, and that can affect your returns.
For sure. And, the state and the government has to try to incentivize these insurance companies to come back, because competition will lower the rates. And that's the biggest thing in Florida. There isn't much competition because people don't want to be here. They're not making money.
Yeah.
So how are you going to sit there and, fight with insurance companies when, one, there's limited places you can go, and, there's no one competing for the business. In fact, they're leaving for the business.
Yeah.
So there's no profitability for these insurance companies. So you're going to pay out the nose no matter what.
Yeah. So, just being aware of it. It's not like you or I can solve this issue today, but I think the awareness of the issue and being proactive, and when you're getting your property under contract or you're getting ready to apply for a loan, start applying for insurance right then and there at that time, because it will become an issue as you get closer to your closing date.
And it goes back to the whole mantra we were talking about, expectation.
Yeah.
People's 12-month expectation of insurance. Oh, yeah, insurance has cost this much. And I get that all the time. And I'm just saying, no, it's tripled. And I'll say that, and they're like, what are you talking about? Yeah, it's tripled. You go look, go get a new quote.
Yeah. Now your 15% return went to 10.
Right.
And you're wondering why at the end of the project.
Right. And then And even too for, our fix and flip, not fix and flip, but our fix and lease product and all these people trying to do their renovations. I mean, we're taking longer policies. We're making sure people pay for 6 months to a year in advance.
Yeah.
Because we don't know what the policy changes are going to be. We need those things locked in, and because you don't know tomorrow the product might be gone.
Yeah.
So for us as lenders, it's like, okay, are we gonna do a month to month or a 3 month? No, get 6 months to a year, because that product that you're signing today, tomorrow could be absolutely.
And we literally had that happen on that manufactured product.
Yeah.
It disappeared from the market for a short period of time.
And we were worried. We were worried for a minute.
We stopped lending on manufactured homes that weren't on slabs, essentially.
Right.
Because that was a deciding factor.
Right. Who knew that we would have to literally become insurance brokers to understand it that much as far as underwriting now?
It's true. So I guess, we got the insurance, the interest. I guess the last piece that I think we should touch on today would be the bank restrictions and just the ability to procure financing.
Yeah.
Obviously this time of uncertainty and tightening bank restrictions has created an opportunity for private lending.
Right.
Private lending is growing as an industry as a whole, right?
Right. Yeah.
So I think we're, trying to lead the lines and take full advantage of that.
I think people are really starting to understand that hard money is going to be that bridge in this uncertainty, and hard money is going to be the supplement to get people through the other next 24 months. And the right people that know how to use it will be successful in it.
Yeah.
But I think also going in that direction is people have to understand what's available in the capital markets and the bank market. When procuring a deal, I think people before were just like, oh, I got my hard money loan, I'll figure it all out later. That's not so smart anymore, where you have to have the correct understanding of, okay, when I'm getting out of this, I'm going to have to either put more money down or maybe not put more money down. I'm not going to be able to get a 90% loan. It's going to be 75%.
Or improve the value.
Improve the value, and I'll have to leave X amount of dollars in. Where before in real estate, it was like, oh yeah, I do, I stabilize the asset, I get all my money out, and then I go on to my next project.
That's a really good point, actually, because that happened to us on one deal where from a loan to value perspective on the refinance. And just to be clear, we're using hard money too.
Yes.
We use on those houses we're talking about, we use hard money. We're buying it, fixing the property up, and we're refinancing to a 30-year debt service coverage ratio loan, a DSCR loan. So when you're doing so, creating that value in the asset, we had to, on the LTV, if the bank said 85% loan to value is what you can get out of the appraised value at the end. Well, we were able to leave no money in the deal from a loan to value perspective, but from a debt service coverage ratio perspective, it was actually closer to 70% loan to value. Right. Because a lot of these institutional hedge funds or banks, they have covenants that are more so 85% loan to value or 1.25% DSCR, not to exceed.
Right.
And so it's the greater of. And so in this instance, it's, yes, you can get the 85%, but your cash flow is not hitting. So you actually need 70%.
Right.
And if you're not aware of those covenants in whatever bank you're going to or hedge fund, that can, if you don't have the cash available, that can be a problem.
Right. And then if you're stuck on higher interest debt for too long, it blows the deal in general.
Sure.
So it puts you into navigating rough waters and can back you into a corner, not understanding how to exit properly.
Yeah.
Or not being prepared to leave the money in.
Yeah.
Because I've had several investors, and we've had several investors where we have to say, no, you have to sell because you didn't prepare enough cash reserves to weather this storm. And rather than go into financial distress, the sell is your own option. And not that they took losses or anything like that, but that's the advice we have to give because they are not prepared.
Yeah. Over leveraged. That's kind of what you were saying earlier.
Yeah.
It's giving yourself options so you can sell or refinance. And when you can't achieve the refinance, you have one option.
Exactly. And we've prepared ourselves to be conditioned for any of those things. If we leave money in, great. If we don't leave money in, even better. Can we refinance out the long-term debt? Yes. Can we keep, even there's some times where we're even willing to hold the hard money a little bit longer because we've made the deal and evaluated the deal properly to sustain it.
That's a great point, actually. And we're seeing that a lot on our book of business as lenders. A lot of our loans are renewing for the second year, not because, they're in distress, but because it's actually one of the best options available to them at that time.
Right.
Because they're not over leveraged. Their cash flow of the property can sustain the higher interest rate for a short period of time. Because don't forget, when you lock in these 30-year loans, you have these prepayment penalties. So it might be a 3 to 5 year prepayment penalty. So for instance, if you're at 12% interest
Yeah.
versus 8% with the bank,
Yep.
you're at 4% difference. But if your prepayment penalty is 3 to 5% for the first 3 years,
Right.
you can run those numbers, and sometimes it's within your best interest to stay on the higher interest rate because it provides more flexibility.
Right. And
So
all of that brings you back.
depends on your deal.
Right. And that brings you back to the same thing what we're talking about, buying right. Like we said. It's just,
And understanding your numbers and evaluating the property.
yeah.
But it is, to recap it, it's expectations and reality, right?
Right.
We're just going through a shift in the market, and so staying in touch with reality versus what you're accustomed to is really important.
And going to that is like, how many people got involved in real estate in the last decade? They don't know what real estate was like before that.
Yeah.
That's why for us, and especially for me, being involved in 20 years, I've got to see that.
Yeah.
And for you, I know you're up to date on all the information now. So you read a lot into the history. So you follow those trends. So you're very familiar with it. But a lot of people who just involved in the last 10 years, they don't know what it's like to stabilize with those high interest rates, and they get nervous and they don't know how to analyze that way.
Yeah.
Where we do.
Yeah. And so, aligning yourself with partners who do, or finding those resources we provide that resource to our borrowers. And it's about aligning yourself with the right people, to try to navigate it if you're not one of the people that have the experience. So,
Yeah, for sure.
So overall, I think, the takeaways here are that we are in a changing market. There is a great divide currently between reality and expectations. And that can go from, buyers, sellers, interest rate expectations, market expectations of asset values. There's a great divide. And yet there is still a great opportunity.
In chaos, there's opportunity.
Always. And so, there are ways to navigate that. And so, not to anybody be discouraged. It's a tough market. You need to accept that reality, but there's still a lot of opportunity to make money.
Tons of opportunity, tons of money to make.
Yes, sir. So, all right. Well, thank you everybody for joining us today. It was a pleasure. Anything you want to add?
Nope. Stay tuned and keep watching.
Awesome.
All right.
Thanks for tuning in today with How to Make Money with Hard Money. Please follow us on all social media platforms at DKC Lending, and contact us or reach out on any platform if you have any questions.